Hello Year 11, it's Mr. McLean here, and in this video I want to walk through the process of constructing the three financial statements for a very simple scenario. So here we've got the facts that we're going to be dealing with on screen, so I'll just read through them. You have just started a job at McDonald's where you will earn $100 a week paid as a fortnightly wage. Your only expense is a new mobile phone contract which costs $20 per week, which you pay with your credit card. You pay off your credit card every 4 weeks before any interest is incurred, and any money not spent on the mobile phone is saved in your bank account. So that's the situation. It's pretty straightforward, and that's because this is our first time thinking about these concepts. So whilst doing this for real for an actual company would involve many more assumptions, we're just going to keep things simple for now. So that we can get our head around the basic ideas of what's going on. And it's probably worth mentioning that you wouldn't normally create financial statements for an individual. Normally you only do that for businesses. But again, we're just keeping things simple here, and I've put together a simple scenario that hopefully you might be somewhat familiar with. Now, our task is to construct the three-way integrated financial statements for this scenario. And in doing that, we're also going to include a balance sheet check to ensure that the accounting equation holds true. So what I might do is I'll go to the next worksheet, FinStats, which is short for financial statements. And here I've created the shell of what we're going to be working on. So we've basically got a whole bunch of gaps that we need to fill in. And once we fill in all these gaps, we will have our financial statements fully integrated. Now, in terms of explaining what we've got our income statement, cash flow statement, and balance sheet. So they're the three financial statements. We're going to be doing the calculations over 12 weeks. So each column here represents a week. And it's probably worth mentioning that normally you'd create financial statements over a financial year, which typically in Australia goes from the 1st of July to the 30th of June of the following year. But again, we're just going to keep things simple. We're just going to think of things in weekly terms, and we'll just do it for a 12-week period. The concepts are still the same. Now, in terms of the components of our statement, so for our income statement, very simple here. We've just got income earned and expenses incurred. Just a 2-line item income statement, and they come together to give us our net profit. Again, for an actual business, there'd be many more line items, but the idea is the same. Income being earned, expenses being incurred. What's the difference? That's our net profit. In terms of the cash flow statement, we've got our three typical sections. So cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The only thing worth mentioning is that for our situation, we're not investing in anything. We're not buying assets. We're not buying other businesses. So this section is not applicable. But I've put it here just for completeness, so that you realize that all cash flow statements typically follow this format where you've got the three sections. Now, for the sections that are relevant, we've got our operating activities, which for us will simply be the income that we're receiving when it actually gets paid to us. And then for our financing activities, because we're paying for the mobile phone using a credit card, no, we don't actually pay any cash when we use our credit card, but what we do have to do is make a cash payment to repay what we owe, as a liability. So that's where this is where that will be reflected. And then when we bring all those three together, we get our net cash flow, which is simply the sum of the total of the individual sections. Now, in terms of our balance sheet, that also is following the typical format of having assets, liabilities, and equity. Now, for us, again, it's a pretty simple balance sheet because we're dealing with a simple scenario. For our assets, we've got income receivable, and the reason that arises is because there's a mismatch between when we earn our income and when we receive it. Because if I just quickly go back to our scenario, we're earning money every week, $100 a week, but it's only getting paid to us every fortnight, and that's not uncommon. If you've already started working or you start working soon, what you'll notice is that often you don't get paid every week. Sometimes you get paid fortnightly or monthly, and so there is a timing mismatch between when you've earned the money, when you've done the work, and when you actually receive it in cash. And therefore, in the meantime, what gets built up is an asset because somebody owes you something. Your employer owes you that money. Our other asset will be the money that we build up in our bank account, because the difference between what we earn and what we spend is just going to help make our bank balance grow bigger and bigger. So that will get reflected here. And then we've just got a total where we just add up those two things. Now for our liabilities, it's the credit card that we have to pay off. So as we use that credit card to pay for our expenses, a liability builds up, and then as we make the repayment, that liability disappears. And then equity is simply our retained earnings. So as we generate net profit, that gets retained for us, and we reflect that as equity. It's basically the difference between all the assets we've generated and all the liabilities we've generated. The difference for us will always equal the retained earnings that we're building up over these 12 weeks. Now, the other thing worth mentioning is that in the balance sheet I have set up this check. And so you may remember in our task, we wanted to include a balance sheet check to ensure the accounting equation holds true. So the accounting equation is that assets equals liabilities plus equity. So I've just created a little formula here where I use an if statement to say if my assets, which are in this blue cell, if they're equal to the liabilities in the red cell plus the equity in the purple cell, then that's okay. Return the word okay. Otherwise, return the word error because something has gone wrong, because this accounting equation should always be true. And so I've taken that formula, I've copied it across for all the weeks, and we just want to keep an eye on that not showing an error. Now, before we go and work through each of these assumptions, something we can do is we can build in a few of the linkages, because remember, these three financial statements are integrated in that they talk to each other and they affect each other. And the first kind of interaction that we can build in relates to the bank account and the net cash flows. So the cash flow statement affects the line item of our balance sheet called bank account, because essentially our bank balance will be equal to whatever the balance was in the prior period plus whatever net cash flow is reflected in the cash flow statement, because that's then just going to stay in our bank account. So I can build that formula. I can just select this cell, press equals, that's how it works in Excel, and then I will select the prior period balance, which is nothing to start with, and I've just indicated this is just a blank cell, that's fine, plus the net cash flow in the current period. And I'll press enter, and I'll just hover over this right hand side and drag across, and the formula will update so that every time it's simply referring to the prior period balance plus the net cash flow from the current period. So the values are all still 0 because we haven't populated anything yet, but that formula will update, the values will update as everything else gets filled out. Now the other linkage is between the income statement and the balance sheet, and that occurs via the retained earnings line item, because our retained earnings builds up as we generate net profit. So here I can say the retained earnings in any period will be equal to the prior period retained earnings plus the net profit we generated in the current period. And again, I can drag that over, and the cell references will update to always be referring to the prior period balance plus the current period net profit. So everything's still 0 because we haven't populated any values yet, but these formulas are now ready for when we do start to fill this out. So let's come back to our scenario. The format of what we'll do is we'll work through each assumption one at a time. What I'll do is I will give you a chance to think about which financial statement line items will be affected by each assumption. So you have to think about that. We'll pause so that you can think about that, and then we'll come and actually build it in. So for the first assumption, you have just started a job at McDonald's where you will earn $100 a week, paid as a fortnightly wage. What line items of the financial statements will that affect? Have a think. Alright, so hopefully in thinking about that, you got to the point where you realized earning $100 a week paid fortnightly will affect our income earned line item as we earn the $100 a week, our income received line item as we get paid every fortnight, and then our income receivable asset, because when we've earned money but it hasn't been paid yet, that creates an asset for us because we're owed money from our employer. So what I'll do now is I'll fill out those figures. So for our income earned, each week we're earning $100. And rather than just type 100 in all of these cells, I'll just save myself a bit of time. I'll just say the value is always just the same, so it's equal to whatever it was in the prior period. I'll copy that across, and there's our $100 in every week that we're earning. Now in terms of when that gets paid to us, we're paid fortnightly, so only every 2 weeks. So in our first week, we will not get anything paid to us. In our second week, we get paid, and I'll create a formula for this, equal to the sum of the current week and the week before, the 2-week period. So there's our $200, and what I can do is I'll just copy these across rather than repeating that. And the formula always updates in Excel to refer to the right cells. So there's our fortnightly cash being received. And now you may notice that some errors popped up in our balance sheet check because there's still one more line item we need to reflect, and that's the income receivable. So have a think about how that income receivable might be affected. So conceptually what we're dealing with is we've earned $100, yet we haven't been paid. So we're owed $100. Now in the next period we earn $100, but we get paid for both that earning and the week before. So our what is owed to us, our receivable, gets reduced every time we get paid. So the formula I'm going to use to reflect that is I'm going to say my income receivable is always equal to whatever it was in the period before plus whatever I've earned minus whatever I've been paid. So if I just press enter there, you'll see that in this first week I am owed $100 because I started with nothing being owed to me. I earned $100 and I didn't get paid. Now when I drag this across, we're going to see that the receivable, what's owed to us, disappears because now we were owed $100 to start with, and we're owed another $100 because that's what we earned this week, but we got paid $200. So what's owed to us gets reduced by $200, and so we're back to where we started. And now again, if I copy that across, we will see the pattern that every 2 weeks we're building up something owed to us, and it gets extinguished as we get paid. We're owed some money and then we get paid, and so on and so on. And our balance sheet is back in balance, which gives us some confidence that, at least for this first dot point, we've captured all the elements. So now let's move to the second assumption, the second dot point. Your only expense is a new mobile phone contract which costs $20 per week, which you pay with your credit card. So have a think, which line items of the financial statements will be impacted by this? Okay, so hopefully after thinking about that, you got to the point where you realized the mobile phone contract is an expense, so it's going to affect expenses incurred in our income statement. And because we're paying for it with our credit card, we're also going to have our liability getting bigger. So we're incurring $20 a week. So what I'll do is I'll reflect that as a negative 20 because it's an expense. So it's kind of like negative income is how it's often reflected in these financial statements. And again, rather than type that in every cell, I'll just use a formula that I can drag across to reflect our negative our expense, our negative values for our expenses of being negative 20 all the way through. And that gives us a net profit of $80 each period. So each week we're getting having $80 left over. Now, in terms of the liability, so the way I can reflect that is I'll say what I owe the credit card company is what I owed them before, which again starts as nothing, minus this expense. And the reason I minus it is because hopefully you remember from your math, hopefully, that subtracting a negative number gives you a positive number. And we want the liability to get bigger, not smaller. So now as I drag this across, you'll see that every period the credit card liability is getting bigger and bigger by $20. And balance sheet still okay, so it looks like we've captured everything there. And now we can move on to the next assumption, which is that we're paying off the credit card every 4 weeks. And because we're going to do it at that regularity, we're not going to incur any interest, and we don't have to worry about all the complexities that might arise with interest. So have a think, what line items of the financial statements will be impacted by this assumption? Alright, so hopefully it's no surprise that the credit card repayment line item needs to be updated because it's basically the only one left that we haven't done yet. But also the credit card payable line item, the liability, will also get affected because as we make the repayments, the liability needs to decrease. So here in terms of the repayments, we're repaying our credit card every 4 weeks, so we'll have no repayment for 3 weeks. And then in the 4th week, the repayment will be the sum of these 4 weeks of expenses. And I'll just copy this over a few more times to repeat that pattern. And you may notice we've got our balance sheet in error, and that's because we still need to update our credit card payables. So here, the credit card will be reduced by our repayments. So again, I will subtract the repayment so that we're I should add the repayment so that we reduce the liability for the amount being paid. So when I press enter, I'll drag that across, and now we're back to being okay in our balance sheet because you'll see that the liability builds up, and then as we make our repayment, it's extinguished, and then it builds up again, extinguished, builds up again, extinguished. And now the final point of our scenario, any money not spent on the mobile phone is saved in your bank account. Well, that was already in effect reflected when we built our integration of our bank account to our cash flow statement, because in effect the net cash flows here is what is money not spent on the mobile phone, and so that is building up our bank account. And we see now that by the end of our 12-week period, after we're earning our income and incurring our mobile phone expense and actually doing the cash flows, by the end of the 12 weeks we'll have $960 built up in our bank account, and that's equal to effectively the total of our net profits. And in the meantime, we have things owed to us and things we owe to others, which kind of build up and get extinguished. And all the while, the balance sheet is in balance, which means we haven't made any mistakes.